So you already made a budget, but how do you know if your business actually followed it? Hmm. Today, I'll show you a simple technique that would help you compare what you planned in your budget with what actually happened. That's the real deal. This is called variance analysis, and it's one of the strongest tools to help you as a business owner spot overspending, spot low sales, and spot hidden losses before they damage your business. Hi, good afternoon. My name is Jidobi Ngozika. I'm an accountant and a finance educator, and this is Accounting Simplified. In this YouTube channel, we help business owners give them tips on how to grow their business and avoid some losses. If it's something you would like, consider subscribing to this channel. Welcome to my new subscribers. So good to have you. I'm so excited to share today with you. Now let's jump right into today's video. Now, like I said earlier, we're talking about variance analysis. Now, for lack of using jargons in accounting, variance analysis simply means the difference between what you budgeted and what actually happened. You know, like some girls, when they want to get married, they say, I want a tall, dark, handsome, good looking man. That is their budgeted husband. But in the reality, when the men are not coming, they would have to manage what they see. That is the actual. Alright, so that is what variance analysis is all about. It's the difference between what you have budgeted for your business, what you have planned. In our previous class, we talked about budgeting. And budgeting, like I talked about, is just a plan. What do you estimate to be your estimated income? What do you think will be your expenses for the period? Now, this estimate or this plan you think you would have for a particular period is based on a track record of what has been happening before. And at the end of the day, you want to see whether you're going to make profit or loss, because everything we do in business most times still boils down to profit or loss. So why do you have this budget? You have this budget so that you can make profit. You expect to make high sales. You expect that your expenses will be low so that you can do what? Make more profit. That is your budget. But if in your business you notice that you're expending so much money based on your track record and your sales is low based on your track record and you put that as your budget, that is fine and good. But it only tells you that at the end of the day you're making a loss. So that brings you to thinking, how do I make profit? The good thing about this kind of scenario is that you're being realistic with yourself based on your previous record, and you can see that you're making losses. And so you begin to think, how do I now make profit in my business instead of loss? Because you're in business to make profit, not to make loss. But let's use a very ideal scenario whereby you're making profit in your business and then you budgeted based on your previous expenses that were low and your previous sales for the previous month that was high, you made a profit. Now you now use that assumption, what happened in the previous month, to set the budget for this month. And then at the end of the day, you actually see that the sales that you thought would be high is not high. Instead, it is low. And then the income, the expenses that you thought would be low is not low. Instead, it is high. And that is a variance, that is a difference. You have planned that you're going to make high sales, but you're making what? Low sales. You have planned you're going to make low expenses, but you're making what? So much expenses. And that is what variance is all about. What actually happened and what you planned that will happen, that is what variance analysis is all about. That is what variance simply means in simple layman terms. Now, how do you get your variance? Variance is the difference, like I said earlier on, between what actually happened in your business and the actual thing that you planned would happen. Just like the woman that planned to marry a handsome, rich, dark, six-figure, tall man, and ended up marrying a short, pot belly man. There's a great variance. Okay, now let's continue. So, how do you calculate your variance? Variance is simply the difference between your actual minus your budgeted. So let's assume like I said earlier, you plan to make 5 million naira for your profit based on your previous expenses. You now did a budget for this year. And let's say you had assumed you're going to make a profit of 5 million naira. That is your planned budget. Based on your budget, you say that my profit will be 5 million naira. But at the end of the day, what did you end up making? You ended up making how much? 3 million naira. Now, that 3 million naira is the actual profit that you made in your business. So there is a difference of what? 2 million naira. Now, the next question you should ask yourself is that this variance, this difference that I'm seeing between what I planned and what actually happened, is it good or is it bad? We'll talk about that as we go together. I want us to take this step by step. Hope we are making sense. Please grab yourself a cup of water so that you can be sipping the water as we carry along in this video. Now, why is variance analysis important? Why do you need to compare at the end of the period between what you planned and what actually happened? Now, why you need to do this is for you to know the performance of your business. If what you planned would happen is what actually happened, and if it did not happen like that, the question is why? Why didn't it happen? Now, let's say in a case whereby your expenses that you planned you're going to incur will be lower, but instead it is higher. It means you have to do what? Control your spending. So you have seen that, yes, I plan to spend 5 million naira, but I ended up spending what? 8 million naira. You can see that that is a clear difference. And that 3 million naira is so much money. You have overspent. Now, because you're able to review your expenses, you're able to review your budget and compare what you planned with what actually happened, you have seen that you have overspent. What will be your line of action? The line of action will be what? You're going to control overspending. Are we together? Now, you have seen that. Let me give another instance. Now, let's say you expected to make a profit of 5 million naira and they made a profit of, say, 2 million naira. You can see that your sales went down instead of what? Going up. So with this, you're able to what? Track your sales. Are we together? Now, all of these differences that you have observed in your business will help you make what? Better decision. That's the aim of all that we are doing, to help us decide that yes, I planned that we do XYZ, but I ended up doing what? ABC. You will now make a decision. You will now put in controls, things that would help you ensure that you achieve your XYZ instead of ABC. Are we together? So where there are places you need to adjust your price, you adjust your price so that you can meet up to your target. Are we together? Now there are several types of variance. There could be difference in your sales, there could be difference in your expenses, there could be difference in your profits. They just have their different names: variance, revenue variance, expense variance, profit variance. It simply means there's a difference in your sales. You plan to sell 5 million naira, so you make a sale of 5 million naira, but you made a sale of what? 2 million naira. So that difference in the revenue is what? Revenue variance. It simply means difference between what you planned and what actually happened in your sales. That is revenue difference. I want us to use simple language so we don't get confused. Now, when your expenses that you planned is different from what actually happened, we call that expense difference. Are we together? And then when there's a difference between the profit that you planned and the profit that actually happened, we'll call that profit difference. Are we together? Now, like I said earlier on, some differences are good, some differences are bad. In a case whereby you plan to spend 5 million naira as your expenses and you end up spending 3 million naira, that is a good difference because you're able to save what? 2 million naira. If you had spent the whole 5 million naira, that would be more expense. But for one reason or the other, you end up spending less than you planned to spend. You have saved that 2 million, so that is a favorable difference. Are we together? Also, a case whereby your sales was lower. Let's say you estimated to make a sale of 2 million naira, but you made a sale of 3 million naira. That is a higher sale. That is a good difference. Are we together? That will also affect our profits. Are we together? But in a case whereby you plan to spend 5 million naira and you spent 8 million, that is a bad, not bad, but this favorable what difference, because you didn't plan to spend so much expense, but maybe because of one reason or you ended up spending more money. That is what an unfavorable what difference. Now let's use life example so that we don't just be speaking in thin air. Let's assume that you budgeted to make a sales of 500,000 naira in the month of October. That was your budgeted sales based on what happened in September. You expected that your sales would be 500,000 naira. And then at the end of the day, what actually happened? You made a sale of what? 450,000 naira. Now, for us to compare and know the difference between what we actually plan to have and what actually have, I'll be subtracting the actual, which is 450,000 naira, minus the budget of what I planned, 500,000 naira. So now give me what? 50,000 naira. This variance, this difference is what? Unfavorable. Why? It is lower by what? 50,000. We plan that we're going to make 500,000 naira, but we ended up making 450,000 naira. It's not so bad, but it's lower. Are we together? Another example I want to give is with our expenses. Let's say you plan to spend 200,000 naira, but ended up spending 170,000 naira. You can say this one is a good one. You spent less money. So by the time you do 170,000 naira minus 200,000 naira, you'll be left with what? 30,000 naira. So you spent less money, which is a good thing. This is a favorable difference. Now, what do you do with all these variances? It's going to help you, like I said, to make decisions. Like when the variance is what? Unfavorable. When the difference is what? Unfavorable. It's not what we want. We'll cut unnecessary spending. Are we together? We'll improve our sales strategy. Like in the case of where we had 450 instead of 500, we have to improve our sales strategy. That is the benefit of this review. You're able to see what actually happened and what planned to happen, and then you now make decisions. Places where you spend so much money, you find out how you can cut unnecessary spending. Do you understand? Especially that unnecessary, you have to find a way to reduce it. Wherever your sales is lower than you're expecting, find ways to improve it. Are we together? You can review your price. That is one thing you can do. Review your price. That might help you increase your price, and then you can also make better sales. You can also negotiate with your suppliers to give you a product at a discounted price, or look for other suppliers that will sell you the same product at the same with the same quality but at a better price. That way you are thinking. That way you're reducing your price. Are you together? Now, when the difference is favorable, like in the case of our expenses in this scenario, we had 170,000 as what actually was spent as against 200,000. We will now maintain that one. We will maintain because it is a better expense. It's lower than 200,000 naira. And every time in business, you want to find ways to lower your expenses. So if your expenses were lower, it means you're going to maintain that particular methodology that made you have a lower expenses. You understand? You can now set new targets. And then once you're able to reduce your expense, you're also making more profit. So once you see that something is working, that the actual is really in our benefit, we now maintain that one and reinforce it and keep using that particular method, because we can see that it's working for us. Are we together? So it is very important that once we do a budget, we must always review it at the end of the month or even middle of the month. You see, you compare what actually happened vis-a-vis what you budgeted for, and see, is the difference big? Is the difference small? Why did it happen? You now know the next action to take, and the one that was favorable, that helped you, that you see that was good, you now use it for the next month. Like for instance, the expense that was 170,000 naira, for my next month I will put 170,000 naira, and I'll try and take those steps I took last month so that this month my expense will still be 170,000 naira or even be lower. Are we together? So you can see that variance is very, very important. It helps you to understand your business performance. How is your business doing? It helps you show whether you're overspending or you're underspending. It helps you show whether you have low sales or high sales. It helps to improve your financial control. You can control your business by making decision. And why are you able to make decision? You're able to do that because you have information. Like I always advocate, to record everything you do. If you're not able to record your transaction, you're just like playing tumbo tumbo. But if you're in business, you must have a record of what you're doing anywhere. There must be a place where it's being recorded somewhere in an organized manner so that you can make decision. If you write one record in one book, another one in another book, and want to make decision, you don't know where the books are, you can't make decision. But if it's organized in a particular book with a particular heading, you've not learned how to write your records, watch my previous video. I've talked about how you can record almost anything in accounting. Check out my videos, sales recording, sales daybook, purchase daybook, and learn so that you can improve your business and then have control. Because you have your numbers properly written that you can control, you can compare and see what is happening. And then you can now find way to improve your performance. Are we together? So you can see that with difference analysis, with your variance analysis, you can run your business with confidence. You would always know where your money is going, what is working, what you need to change, what you need to improve. If you found this video useful, make sure you subscribe to Accounting Simplified for more business simple tips and accounting lessons. See you in my next video and thank you for watching to the very end. Bye.